Hello friends, we will continue our discussion on the chapter of admission of a partner. And in the last lecture we started with a discussion on treatment of reserves and accumulated profits and losses. Right? So we started with reserves and accumulated profits and losses. So what we discussed in the last lecture, I simply told you that reserves are nothing but the profits only, because the reserves are the amount set aside out of the profits to meet any future contingencies. So anything that is earned before the admission of a new partner must be distributed among the old partners in old ratio. Among old partners in which ratio? In old ratio. Clear? So that means on the date of admission of a partner, any reserves and accumulated profits and losses appearing in the balance sheet, listen carefully, on the date of admission of a partner, any reserves and accumulated profits and losses appearing in the balance sheet of the firm must be distributed among old partners in old ratio. Clear, friends? In this, there are various types of reserves, like we have journal reserve. Then I told you about workman compensation reserve. This reserve is created to meet any contingency towards the workers who are working in a factory. Right? If there is any contingency claim against the workers, so we will write off that claim through workman contingency reserve. And the balance reserve is transferred to old partners in old ratio. Clear, friends? Then I told you the investment fluctuation reserve. What is investment fluctuation reserve? If there is change in the market value and the book value means the value that is appearing in the balance sheet, and if you go in the market and value that investment, if there is any difference between the market value and the book value of the investments, and if there is a loss on that, that loss will be written off from the investment fluctuation reserve, and the balance reserve will be transferred to the partners' capital accounts. Which partners? Old partners' capital accounts in old ratio. Clear? Now let's see a practical problem on this. Read this practical problem. A, B and C were partners in a firm sharing profits and losses in the ratio of 3:1:1. On 1st of April 2016, their balance sheet stood as asset side, land and building, machinery, furniture, investments appearing in the book at 30,000, whereas the market value of the investments is 28,000. In the book, the investments are appearing at 30,000, but in the market, the investments are valued at 28,000. That means there is a loss of 2,000 on investments. In the new balance sheet, the investments will appear at the market value of 28,000 and not 30,000. We have the current assets of 1,18,000 and advertisement expenditure, that is a deferred revenue expenditure of 25,000. On the liability side, we have the capital accounts of A, B and C. We have journal reserve, profit and loss account of 35,000, investment fluctuation reserve, workman compensation reserve, employees provident fund and creditors. They admitted D into partnership for 1/5 share of profits on the above date. A claim for workmen compensation is estimated at 13,000 only. Give necessary journal entries to adjust the accumulated profits and losses. Right? First of all, when we have investment fluctuation reserve and we have some information regarding the investments, we will treat that. Then we have workmen compensation reserve, we have some information regarding the workmen compensation reserve, we will treat that. After that, whatever reserves are left, we will distribute among the partners in old ratio. Clear? Now, what is given about the investments? See, if we talk about investments, the book value of the investments is 30,000, whereas if you go in the market and sell those investments, you will get only 28,000. That means you are having a 2,000 of loss. Right? This loss we will write off through investment fluctuation reserve, that is appearing in the books at 20,000. This investment fluctuation reserve, what is the purpose of creating this investment fluctuation reserve? The purpose is to meet any loss arising on account of difference between the book value and the market value of investments. So there is a loss of 2,000. We have already created a reserve of 20,000. So we will meet this loss of 2,000 through this investment fluctuation reserve. What will be the balance reserve? The balance reserve is 18,000, and this reserve will be transferred to old partners in old ratio. Clear? Second, workmen compensation reserve. What is the amount of reserve? Amount of reserve is 23,000. Now you created this reserve to meet any contingency relating to workers. During the year, one of the worker got injured and the treatment for that costed 13,000. You have already created a reserve to meet any such contingency towards workers. And during the year, one of your worker got injured and the treatment costed 13,000. So you will meet this contingency, this claim, through this workmen compensation reserve, and the balance of 10,000 will be transferred to old partners in old ratio. Clear? So let's pass the journal entries now. First of all, we'll talk about investments. The loss on investments, the fall in the value of investments is met out of investment fluctuation reserve. So I can say investment fluctuation reserve account debit. Why I am debiting this? I am reducing something on the liability side, and if you have to reduce a liability, you have to debit that, right? To investments account. The value of investment will go down by 2,000. The value of investment, the value of our asset is going down by 2,000. So we will credit the asset and debit the investment fluctuation reserve, because this loss of 2,000 we are going to meet through investment fluctuation reserve account. Clear? Now, workmen compensation. There is a claim of 13,000 which we are going to meet through workmen compensation reserve. So I will say workmen compensation reserve account debit. Again, I am reducing my liability by debiting this reserve account to, I'll say, provision for workmen compensation claim account. There is a claim of 13,000. This claim we will set off with the workmen compensation reserve that we have created to meet any contingency towards our workers, and during the year there is a contingency amounting to 13,000 that we are going to compensate from workmen compensation reserve. Right? Now, the balance reserves we will distribute among old partners in old ratio. What are the balance reserves? See, there is a general reserve of 25,000, there is a profit and loss account of 35,000. The balance of investment fluctuation reserve we will transfer, and the balance of workmen compensation reserve we will transfer. So what is going to be the journal entry? Our journal entry will be journal reserve account debit with 25,000, then profit and loss account debit with 35,000, then I will say investment fluctuation reserve account debit. What is the balance of investment fluctuation reserve? 20,000 minus 2,000 loss already met through reserve. The balance left is 18,000. See, the balance is 18,000 because the loss of 2,000 we have compensated through investment fluctuation reserve, and the balance reserve is transferred to old partners. Workmen compensation reserve account debit. The total amount is 23,000. During the year there is a claim of 13,000. What is the balance left? 20,000. Clear? Any other reserves on the liability side? You will say, sir, there is a reserve named as Employees Provident Fund, 30,000. We will distribute this. No, my friend, we will not distribute the Employees Provident Fund because this is a liability. We have to pay this. Right? This is not optional. Other reserves, if we talk of workmen compensation reserve, it is optional. We will compensate only if there is a claim against the workers. But Employees Provident Fund we have to pay. This is a liability. So this liability we will not distribute among partners. So I will say, who are the old partners now? To A's capital account, to B's capital account, and to C's capital account. Clear? Sorry, this amount is 10,000 here. So what is the total amount? Whatever is the total amount, we will distribute among old partners in the ratio of 3:1:1. So this amount comes to 52,800, 17,600 and 17,600. Clear, friends? We have distributed the balance of the reserves to the old partners in old ratio. The investment fluctuation reserve, we will first compute if there is any loss arising on account of difference in the book value and the market value. If there is a loss, we will compensate that loss from the investment fluctuation reserve, and the balance reserve will be transferred to the old partners in old ratio. Then if we talk of workman compensation reserve, any claim arising towards workmen will be compensated through this reserve, and the balance reserve will be transferred to partners' capital accounts. Clear? Now, one more thing. There is a deferred revenue expenditure, advertisement expenditure arising, costing 25,000, that it is shown on the asset side. This is an accumulated loss. Deferred revenue expenditure we will write off among the old partners in old ratio. So the entry will be A's capital account debit, B's capital account debit, C's capital account debit to advertisement expenditure. This is total 25,000. So this will be written off among old partners in old ratio. Clear, friends? So how to treat the reserves? Any reserves appearing in the balance sheet on the date of admission of a partner are to be distributed among old partners in old ratio. Friends, for detailed discussion on this reserves topic, you must go through change in profit sharing ratio chapter. There I have discussed these reserves individually in detail with the journal entries. Right? So I will suggest that you must go through those chapters first, go through those videos first, and then you will be able to understand this very easily, because this topic we are going to get in the next chapter also, that is retirement of a partner. So I will suggest you must go through change in profit sharing ratio chapter videos, right? After that this will be very easy job for you. Now if I say, now we have studied calculation of the new profit sharing ratio, we have studied the sacrificing ratio, we have studied the goodwill, we have studied the revaluation of assets and liabilities, and now we have studied the treatment of reserves and accumulated profits and losses. After this, taking this example only, if I say they ask you to prepare the balance sheet of the firm, what will you do for that? For the balance sheet, you will first of all prepare the partners' capital accounts. Remember, in this case, in this chapter, if they ask you to prepare the balance sheet after the admission of the partner, you must first of all prepare the partners' capital accounts. Get the adjusted capital account balances of the partners. Adjusted. Why adjusted? How adjusted? Adjusted means after these adjustments, after the adjustments related to revaluation of assets and liabilities, because there also any profit or any loss is distributed among old partners in old ratio. Right? So always prepare the partners' capital accounts, get new balances of all partners. Right? And then you can prepare the balance sheet. In this case, if we talk of this case only, what will be the balance sheet? Will there be any change in the value of land and building? Definitely not. Any change in the value of machinery? No. Furniture? No. Investments? Yes. Why there is a change? Because now the investments will appear at market value, that is 28,000. That is, the investments in the balance sheet will appear at 28,000. Next, current assets, they will remain the same. Advertisement expenditure, because we have written off this expenditure through the partners' capital accounts, this will not appear in the balance sheet. Right? If we talk of advertisement expenditure, This will not appear in the balance sheet now. Capital accounts. You will get the new balances of 4 capitals A, B, C and D, 4 partners. For that, prepare the partners' capital accounts first. You all know how to prepare a partner capital account. From this journal entry only, you have the opening balances in the balance sheet, and from this journal entry, you can post the entries to the partners' capital accounts and you can get the balance of all the partners. Clear? See, on the liability side, general reserve will not appear, profit and loss will not appear, investment fluctuation reserve will not appear, because we have compensated through these investments. We are showing the investments at 23,000 now. Workman compensation reserve 23,000 will not appear, but sir, one thing will appear in the balance sheet. Be very careful about this. When there is a claim standing against the workman compensation, as the question says, a claim for workman compensation is estimated at 13,000 only. There is a claim standing. This is a liability of the business. So here we will show provision for workman compensation claim to the extent of 13,000. There is a claim of 13,000 that we have met through the reserve, but this claim is to be paid. That is a liability of the business. This claim is not yet paid, therefore we will show this on the liability side as provision for workman compensation claim as 13,000. Be very careful about this. If they ask you to prepare the balance sheet, be careful with the workman compensation claim, with the amount of investments, with the reserves and accumulated profits and losses. In this case, if there had been any revaluation in the assets and liabilities, then the assets and liabilities would have appeared in the new balance sheet at revised values, and any profit and loss arising on the revaluation of assets and liabilities would have been adjusted through the partners' capital accounts, and that effect would have appeared in the capitals. Clear, friends? Employees Provident Fund, yes, it will appear because it is a liability, right? It is a liability. EPF of 30,000 will appear as such in the balance sheet. Sundry creditors, yes, they will appear at 1 lakh, and your balance sheet will tally 100% if your partners' capital accounts are prepared correctly. Clear, friends? So now you know how to treat the reserves and accumulated profits and losses, and how to prepare the balance sheet of the new firm. New firm means including the new partner. For that, first of all, prepare the partners' capital accounts. So friends, I will say you must practice the questions on this topic, right? You must practice the questions from this topic, and if you have any problem, you can always email me at ksjteaching@gmail.com. Clear, friends? If you have any problem relating to the solution, you can send me the image of the question. I'll send you the solution. You can anytime email me at ksjteaching@gmail.com. Right? So friends, in the next lecture now, we'll start with a new topic relating to adjustment of capital. In the admission of partner only, we have one topic as adjustment of capitals. This we will be starting in the next lecture. Clear? So that's all for this lecture. Thank you, friends.